the typical advice is that we need a trading plan, that you have to have it all worked out, write it down in a journal or notebook before you ever hit the submit that order key. But here's the problem. When we come up with a plan, well, as Mike Tyson said, yep, getting hit in the face is like watching something that we thought was going to move in one direction turn around and move against us, or drop so fast, so hard that we wonder if it's even worth cutting our losses, or watching something rise so quickly that if we set a price target for it and we watch it shoot past it, we wonder, oh, do I take the profit now? Do I take it now? Do I wait till it comes back? When can I get the top to this stock?
Christ, that's the craziest notion I've ever heard. A serving line officer, an entire ballistic missile submarine. Hell, they can't all want to defect. Even if it's only the officers, I find it extremely difficult to believe.
What's his plan?
His plan?
Russians don't take a dump, son, without a plan.
You see, a trading plan is a great idea on paper until you actually have to be in the markets and trade. So let's look at a plan that we can actually adapt in real time, something much more realistic than just jotting out an ideal price target or an absolute sell point. Let's come up with a plan that actually makes us money and fits the scenario of the way the markets are trading today. Now, I'm not a financial analyst. This is not advice to buy, sell, or hold anything. You take risk when you enter the market, and the risk can be significant. So what we need to keep in mind, this is how I approach a trade plan, how I try to make more money on a daily basis, so I build up that consistency, so that I build up that nut in order to be able to trade more effectively, to be able to leverage a little bit more of my success. I'm James Callahan, and this is the Do-Over Show, where we've done everything from blow up accounts from great balances to almost nothing and rebuild them again higher and more successful than we had ever thought was possible. And how it all happens is through having an adaptable trade plan. So let's look at some of the things we need to have in a plan that we need to be able to adapt in order to face the reality of markets that swing quickly in favor or against us. So instead of a hard and fast plan to handle all scenarios,
okay. As I was saying, hey,
Somebody broke that.
Okay. Clearly we need to set some rules. Rule number 1. You will not touch anything.
I've learned to adjust my expectations with 3 ideas, 3 rules, and just 3. The first is, am I buying this for the long term, either growth or value with a dividend? And I expect to hold it and add to it for years and years. If that's my approach, I buy it and I leave it alone. I don't check it every day, every minute, or every hour. I don't watch it when the markets are announced that they've swung up high or they've dropped precipitously to a new low. I dollar cost average into more and more each month, or whatever schedule I live with, say in an IRA, to the limit amount of contributions for that year, with every paycheck where I pay myself and I put some of that money into an investment account. If it goes up, I don't sell it because I bought it to grow and I bought it to pay me while I sleep. So that's the plan.
Okay, rule number 2, you will not bother me while I'm working.
Rule number 2 is about trading a stock or an option. And the reason I buy a stock or an option for the short term is to make a profit and to take that profit. It might happen right away, or it might take months for that to materialize. Now, I really don't have any idea what that profit amount will be. I can look at the chart and say, well, this would be an all-time high, or this stock doesn't move that quickly. So if I expect a 20% return on a stock that moves 2 or 3% annually, I'm just being unrealistic, and I deserve to be disappointed. But when I look at something, I don't have a hard and fast rule about what the profit is or what level I'm going to take it. So that's the decision I make next after I'm into that trade. Now remember, the goal of this is to make a profit. So that's what I'm looking for. If it makes a profit, or if it falls and maybe I was just early. And by the way, in the investing world, especially trading for a profit, early is a synonym for wrong. So if I see something moving and getting attention, so I think I'm early enough that this or that just isn't FOMO, and I buy, and say the price is below $15 or $20 a share, I go with the stock instead of buying an option. If I go with the option, I need to buy time because that's what we're paying for when we buy an option, time. But that time gives me an all or nothing date. And rather than a price target, that date, that's the thing that's breathing down my neck. And if it works for me, if the stock or option goes up big, now I have a decision to make to take the profit or to let it ride. But there's another option, and that is scaling out, just like dollar cost averaging my way into a position. So how much is enough to start taking profits? I try to average my way out by recouping first my initial investment. So if I buy 100 shares of a stock at $10 and it runs to $20, I'll sell 50 of those shares, I'll hold 50, and basically it's free money. I'm now playing with the house's money. I've returned to the level of break even, so I haven't taken my profit yet. I have just recouped my initial investment. On a long dated option or owning the stock, I take out as much money as I need to make a difference in my life. Now, a $500 profit, for example, is going to be a significant boost to my balance in my account. I take it. But if $500 is simply a night out for you with bottle service, well then $500, you're going to let it ride because it's not going to be life-changing for you. That's up to your individual circumstance. That's the best advice that people give us about this, and that's the practice that I follow.
Rule number 3. You will not cry, or whine, or laugh, or giggle, or sneeze, or burp, or fart.
And that brings me to my third rule, and that is if I buy options, especially short-dated options, I try to keep my positions small, very small. I try to keep them to 1% of my total portfolio balance. And I also consider that money, when I do that, I consider it gone, lost. I'm not going to see it again. I recoup it. I'm going to let the option do its job for me. If I buy a close dated option and I start small, if I buy five options at 10 cents a piece and I have a $5,000 balance in my account, well, that $50, that 1%, I consider lost, gone. I let the option do its job. I let it run its course. And taking back $25 of that is not going to make a big difference or a 0.5% value add to my account. But if the option runs in my favor because it's short dated, I have to take that money. Even if it goes in the money, too much of the theta wears away. And unless I am deep in the money, I'm not going to recoup my initial investment. So learning to take profits on short dated options, if that's the goal of that move into the market, that has to be what I'm after. Now, another version of this with short-dated options is if I go small and I go in something and it runs wildly in my favor, then I take out my initial investment and I make it free. And there I am back to the part of rule number 2 again, and that is I bring myself to break even. I've recouped my initial investment and I see if the option can keep running, if there's follow through, if it continues, if the FOMO of others chasing it continues to drive the price up, or if there's a delta squeeze. I let it run its course. I've bought that and now it's free. So I live off that and I enjoy it.
So no annoying sounds, right?
Does this count as annoying?
Very.
Now, those are my 3 basic approaches, my 3 rules, so the different types of reasons why I want to be in the market. Either to buy and just to sit in that chair forever and ever, or to make something that's going to increase in value, but put a little bit more money into it by buying the stock or buying an option that's far dated, a leap more than a year out. Or the third idea, if I'm going to go for a quick profit, is to go small and to get my money back as soon as I can and let the option, maybe if it's going to run, maybe if I'm right, work for me. So, hey, thanks for checking in on this idea of trading rules and how we can adapt to the market. And thanks for being part of the Do-Over Show. So please tap the like button because it really helps. And subscribe and ring the notifications bell while you're down there. And remember to come back every Monday and Friday for a next episode of the Do-Over Show. I'm so glad you found me and I found you. Thanks.